War breaks out in the Gulf. Oil fields are burning. Normally, gold would skyrocket. But it doesn't. Gold price crashes. The crowd is confused. The safe haven isn't safe. At the exact peak, big players sold billions in gold. They maximized profit. Small investors bought at the top, thinking war means buy gold. Gulf countries' oil fields are destroyed. They can't pay for reconstruction, imports, or military expenses. To get cash fast, they are forced to sell their gold reserves. Massive supply hits the market. Prices collapse under the weight of this supply. This is not a normal correction, it's a supply shock. Did the whales know this would happen? Was it luck or intelligence? Big players have intelligence networks, lobbyists, and geopolitical scenario desks. They knew the Gulf states' financial stress weeks in advance. Weeks before the attacks, they quietly built short positions. By the time the news hit, they were already positioned. When you see the headline, the trade is over. The whales are already exiting. Retail investor. War equals buy gold. Whale. Liquidity event, time to sell. This is a classic liquidity trap. Retail liquidity allows big players to exit without crashing the price until they're done. Smart money sells to dumb money. Then the rug is pulled. Gulf states flood the market. Price drops another 10 to 15%. Forced sellers meet no buyers. Retail investors are trapped. They bought the top and now face heavy losses. But is this the end? What comes next for gold? First, oil prices explode. Rebuilding destroyed fields requires massive investment. Crude spikes. Higher oil means higher inflation. Historically, gold thrives in inflationary environments. Central banks, especially in emerging markets, have been buying gold for years. This drop is a buying opportunity for them. BRICS nations see gold as a hedge against dollar sanctions. Their demand is structural, not speculative. Short term. Gold remains under pressure due to forced Gulf selling. Medium term. Recovery likely as central banks step in. If the war expands, fear returns. Gold's safe haven status will reactivate. But don't ignore the dollar. If the Fed keeps rates high, a strong dollar can delay gold's rebound. The next months will be a tug of war between physical demand from rebuilding and financial conditions from central banks. History shows that after major supply shocks, gold eventually recovers and often reaches new highs. So what can small investors learn from this? Lesson 1. Never buy when the crowd is euphoric. If everyone is talking about it, the trade is already crowded. Lesson 2. Big players sell the news. If a major event is already priced in, the move is over. Lesson 3. Understand supply and demand fundamentals, not just headlines. Who is forced to sell? Who is buying? Watch central bank purchases. They are the biggest whales. Their actions signal long-term trends. Monitor the dollar. Gold and the US dollar usually move in opposite directions. Understand real interest rates. Negative real rates are gold's best friend. This drop could be a buying opportunity, but only if you have a long-term horizon and understand the risks. Expect high volatility. Never use leverage unless you're a professional. One wrong move can wipe you out. Instead of trying to time the market, consider dollar cost averaging. It removes emotion. Physical gold gives you true ownership but has storage costs. ETFs are liquid but carry counterparty risk. What about the Gulf? They will rebuild. Oil revenues will eventually recover. Once reconstruction is funded, the forced selling of gold will stop. That removes the main downward pressure. At that point, the market will refocus on inflation, geopolitical risk, and central bank demand. The macro environment for gold remains supportive. Record global debt, de-dollarization, and structural inflation. Unprecedented money printing hasn't gone away. Central banks can't easily tighten without breaking something. The de-dollarization trend is real. Nations are diversifying reserves into gold. This is a multi-year structural tailwind. Gold remains the ultimate monetary insurance. No counterparty risk, 5,000 years of history. Lesson 1. Don't chase the crowd. Lesson 2. Understand supply shocks. Lesson 3. Think long-term. So what's your strategy? Will you buy the dip, wait, or stay in cash? If you want to stay ahead of the big players, subscribe and hit the bell. We analyze market structure, not just news. What would you do in this situation? Share your thoughts in the comments. The story isn't over. We'll keep tracking gold, oil, and the whales. Next, we'll cover how to spot supply shocks before they happen. Subscribe so you don't miss it.